Good morning, everybody. I'm Nicola Barrett, Chief Corporate Learning Officer at Emory Executive Education at Goizueta Business School, and welcome to Business Over Breakfast. We kicked this Business Over Breakfast off back in April 2020 with Professor Tom Smith, helping us sort out what effect the pandemic was having on the economy for ourselves, personally, and our organizations. Our goal was at that point, and it remains, helping us move from, survive to thrive, and to help everyone make more informed decisions that set you, your teams, businesses, and communities up for success. It feels like we are still in a time of great uncertainty with inflation, the ever-present talk of a recession, the continuation of the war in Ukraine, strikes happening in many places around the world. I've heard about barristers in the UK. We've heard teachers, nurses, railway workers that fortunately was just averted here in the US. So with all that, happening, it's my pleasure once again to introduce Professor Tom Smith, a champion of these Business Over Breakfast webinars and an expert in labor economics, pricing, sports economics, financing, and the economics of the entertainment industry and healthcare. Tom is a professor in practice of finance at the Goizueta Business School and regularly appears on the media and is frequently quoted in newspapers. In fact, I've been hearing a lot about you lately, Tom, on, you obviously did a spot on NPR recently. Tom is going to kick off the webinar with his observations about what is happening in the economy. And then we will segue to your questions. So please make sure you put them in the Q&A at the bottom of the screen. And Pam and I will do our best to get to as many of them as possible. So enjoy the morning with Tom. We're going to learn a lot. So over to you.
Thank you, Nicola. I really appreciate it. Hello, everybody. I'm Tom Smith. There's a little bit of pollen in the air, so I completely lost my voice a couple of weeks ago, but now it's back, and so I'm happy to do this. You notice I'm wearing my Emory University Goizueta Business School MAF Masters of Analytical Finance shirt that Christine had given me, and so thank you, Christine. I'm a big fan of the MAF program. It's our first year in the program, so do a shout out to Kirsten and Christine, and we've got about 30 odd students who are over there with one of my partners in crime, Dr. Bill, who's working with those students on a lot of analytical programming. And so I want to do a shout out to them because I'm super bullish on that program. I've been working with those students for the last month. And so, you're looking to do some recruiting. Hey, a moment of selfless promotion for Emory programs. Look into these students. They're going to be some amazing recruits in the next 9 months, and so super bullish about them. And a shout out to Kirsten, Christine, and Dr. Bill over there in that program. Okay, let me pull up a PowerPoint and go through some things that are going on in the economy, because you guys want to know what's going on with the economy. So let me share this with you, and let's just jump right into this. Okay, so some of these slides are very similar to what Dr. Bill and I presented back in July, but not 100%. So let's go through what's going on. So top of mind today, right? These first two bullets here is that we still have inflation. The inflation numbers came out the other day. We're still at 8.4% or 8.5% annual year-over-year inflation, still very high, but it is ticking down. So it's not as high as it was, and it is moving in the right direction. So that's a good indicator. I had prepared to talk about this train stoppage, this strike, and sure enough, they worked it out overnight. And this morning, the Biden administration announced that they had come to an agreement that was going to improve the labor position of railroad workers. And so that's really good. Okay. The unemployment rate is still really, really low, very, very low, and doesn't seem to be moving upwards. It surprises people every month when they say, okay, well, we're still hiring people. We're still hiring more people than we thought we would. Of course, there still is some difference between the number of people who are hiring and the number of people that employers want to hire. So there is this gap between how firms want to staff and how many they're able to staff. Okay. And I'd had this up there from the last time we talked about the supply chain brittleness. There are still lots of supply chain issues, and they're percolating through our economy. And these are some of the things that are still causing high inflation. And even though we're working through them, there's still some evidence that these are that they are hanging on, maybe just with their fingernails, but they're still hanging on. Okay, let me talk about some of these things. Okay, so as mentioned, inflation is really high. This is the year-over-year change in our CPI, which is still the way that most everybody is measuring inflation. But you'll notice here, just this little circle, and I put this downward arrow. So inflation is high, but it tapped out 2 months ago, and so it's starting to go down. Now, this is different. So let's say a decrease in inflation is a little bit different than a decrease in prices. That would be deflation. So we're still having an increase in inflation, but we're not having an increase in inflation as high as it was, a month ago, all right? And even as high as it was, about 2 months ago, we're about even with that. So what does this mean? So a year ago, right, prices were pretty low. We hadn't really experienced inflation until November, right, December, going into the spring. And that's when people were talking about, is the Fed going to make a move and what have you. So prices were still pretty low last September, October, which means that the year-over-year prices we're going to see for the next 2 months is still going to show a moderate to high level of inflation, somewhere in the 7 to 8% range. But as we go into December, January, February, what have you, since last year's prices were so high, and that's where we saw that inflation. And right now, prices are kind of stable, going up a little bit, but stable. The level of inflation that we're going to see going into the spring is going to be much lower than 8%. And this is one, just a factor of mathematics, but two, it's a factor of the fact that the Federal Reserve is increasing interest rates. Okay. We are seeing gasoline prices go down. All right. And so here I've got this rate of inflation on energy in US cities, and that went down pretty sharply from a couple months ago in the middle of the summer. People were freaking out and saying, okay, we're gonna get $5 gasoline, or we're gonna get $6 gasoline. Nope, gas is settled under $4. And so people aren't as concerned about gas prices. They're not as concerned about energy inflation. However, for some cities like Atlanta, where we are so reliant on our cars and less so on public transportation, we still are going to have higher, let's say, year-over-year prices in gasoline than for other cities that have, let's say, better access or a more intricate network of public transportation. So gas prices are down. You guys have noticed that, all right, which is good. So, but consumer confidence is still falling. Like, people keep hearing this drumbeat of inflation, and then they're hearing other experts, if you will, say, oh, we're in a recession, we're heading into a recession, recession's inevitable. You can't help but have your confidence shaken about the economy if you are constantly thinking about prices and you go to the store and prices are higher, and then you turn on the radio or TV or just go on the internet and you're hearing somebody say, yeah, we're going to a recession, we're going to a recession. At some point, this really, really, really just beats you up. And I mean, for good reason, right? And so consumer confidence is really at a low. I mean, it's not at an all-time low. These consumer confidence numbers are still better than what we saw, let's say, in 1979 and 1980, coming out of these OPEC oil embargoes, and coming out of the fall of the Shah of Iran, where we had 11% inflation. It was bad times. So these are better than those, but they're not good. Like, people have lost a lot of confidence, but they are hearing, I think, a solid message from the Federal Reserve. Like the Federal Reserve keeps saying, we're going to increase interest rates. We're going to increase interest rates. We're going to increase interest rates. We're going to keep doing it. We've got an eye on the economy. We've got an eye on inflation. And the trick there is whether the interest rate increases are going to push us into a recession, or whether we're already in a recession. Okay.
Tom,
So yeah.
Tom, just a quick question to interrupt you. How
Hello.
do you actually measure the consumer confidence? How is that measured? Can you go?
This is like so there's a survey that's performed by University of Michigan, and then there's something by the conference board, and they just ask people questions about, are you optimistic? Are you pessimistic? Very optimistic, very pessimistic about the current state of affairs. And then they compile those data. They take hopefully a sample of the population that's representative of the full population, and then they publish those results. And the University of Michigan, you can find that data on the Federal Reserve, so the Fred St. Louis website. That's like UMich confidence or something like this. And so it's a confidence survey that's people asking people about just their overall level of confidence in where the economy is and where the economy is heading. Okay. But there's other metrics. And so, you know what, I'm going to go, excuse me, I'm going forward a little bit to show you something. This just was released, about 3 days ago. This is the Pulse survey. So the Pulse survey is a survey that's connected to the US Census. And the Pulse survey, and Dr. Bill and I had relied on the Pulse survey during the pandemic to alert people as to what their current fears were. Were they able to pay their bills? Do they feel that they can make their money stretch throughout the month, and what have you? So the Pulse survey just released their annual report of how things have changed since last year. Right. And so if you look at an individual metric like the confidence survey, you might say people are doing awful. Then what you have to do is you have to look at other pieces of information to try to identify how it is that people are, like, what parts of their confidence is shaken, or where in their lives are they feeling less confident, or where in their lives are they feeling vulnerable. So here, this is just a chart from the survey, and it's asking people how they felt in 2021 and then how they felt in 2022. And so these numbers right here are the delta, are the differences, right? And so we're asking people, okay, so is spending less than or equal to income? So is your income at a level and your spending is at that level or less, right? And so this -6 means there were 6% people this year, fewer people who thought that their spending was at, right, or less than or equal to their income. So if your spending is less than your income, you've got some savings. Or if your spending is at your income, then you feel like you can make it to the end of the month. But there's 6% fewer people this year than last year who think that that's the case. So you say, wait, so then there's more people who think that they can't make it to the end of the month, that their spending is greater than their income, or that their income is less than their spending. Yeah, so those are the indications that people might not be as confident in their financial position. Right? There are fewer people who are indicating that they can pay their bills on time. So these numbers right here, if it's a negative number, it means this year for the Pulse survey relative to last year at the same time, if it's a negative number, it means that there's fewer people this year who are indicating that they can pay their bills on time, or they have enough savings to cover at least 3 months of living expenses relative to last year. And you can look at this and say, okay, so was there something going on last year? Is there something going on this year? Last year, maybe there's still a continuation of some of these programs, some unemployment insurance programs, their stops on, kicking people out of their homes and rent kind of coverages and things of this nature. And then a lot of those stopped last year. And so now people are on their own, like no more fiscal sort of umbrellas. And people are saying, they have less confidence. There's fewer people who are saying they have enough savings to cover 3 months worth of expenses. Fewer people are saying they can't pay their bills on time. Fewer people who are saying that, yeah, their income can cover them, get them through the end of the month. Okay. But
Tom,
yes.
Jeff asks, how do you explain the -6 result with the +1 for manageable amount of debt?
So, I mean, it's the different questions are asked in sort of slightly different context. And so these charts really represent the responses to an individual question, right? And so if you have you can have more people who are saying right now, my income is, let's say it like this. There can be fewer people right now who think that their monthly income doesn't cover their monthly spending. But over the course of the pandemic, they were able to eliminate and or take care of the debt that had accumulated prior to the pandemic. So you can have those things at the same time. So you can say, okay, I had $20,000 worth of credit card debt going into the pandemic. I was able to use some fiscal stimulus to pay that down. Now I only have $8,000 worth of credit card debt. So my credit card debt is more secure or less, what have you. But my current situation is I'm still living hand to mouth or a little bit less. So the credit card debt might be a long-term movement or a movement over a couple years where you are consolidating your debt, right? Moving it from higher interest rate credit cards to lower interest rate credit cards, getting kind of some kind of a secured home equity loan or a HELOC, if you will, right? And over the course of that time, I don't think it's a mistake that those people have also seen their credit scores increase. So people said, okay, during the pandemic, I'm going to use the programs that are available to me, consolidate my debt, pay some of that off, and increase my credit score. But then on a month-to-month basis, they're like, okay, even though I've taken care of that, my spending is still greater than my income, or my income is less than my spending. But also the top number could point to the fact that as consumers, we still tend to overspend. I mean, our saving rate as a country is awful. And the average family has, I'm going to think about 500 or a little bit less than $500 in the bank account, in a bank account in savings. So these metrics don't conflict with each other. Long-term movements versus short-term movements. I don't know, Jeff, was it Jeff who asked this question? Does that make sense?
Yeah, it was Jeff that asked that question.
Okay.
There was another question here. Let me see. Lauren asked, does the fear index have an impact on the consumer confidence?
I don't, I'd have to look at which fear index that is. There are a handful of indices, like I mentioned. The Conference Board offers one. University of Michigan offers one. I am sure that there are. I think the fear index is a composite of movements of other metrics. So I'd have to double check the definition of that before I expound on what my thoughts are, because I don't want to guess on what I think that is. And so I just have to look at what that is. And I think, yeah, I mean, I don't want to speculate. And so maybe let me do some research. I was going to go back to the Fed for a second here, because people want to know, what's the Fed going to do and what's going on. So the Fed keeps saying, look, we're going to increase interest rate targets. Okay, we've seen these 75 basis point, 75 basis point, 75 basis point movements. And people are saying, okay, is the Fed going to continue this? How long are they going to continue this? And they've been true to the world. They've been true to their word. So the Fed says, look, we are going to increase interest rates by 350 basis points this year. And they're on a path to do that. And they keep doing exactly what they say they're going to do. which is what you want from your central bank. So the central bank, you want the central bank to be paying attention to these numbers, and then you want the central bank to say, this is what we're going to do, and then you want them to do it. So that you say, oh, okay, like you're not playing around. I don't have to second guess what you're going to do. And then they say, okay, well, you know what, inflation hasn't been tamed. So probably another 75 basis point movement, in September. So we have a meeting on September 20 and 21st. So next Wednesday and Thursday, I think, or Thursday and no, yeah, Tuesday and Wednesday, Thursday. So Tuesday, Wednesday. So they're gonna make another move, and the move I believe they're gonna make is another 75 basis point increase. And when that happens, and when you don't see people freaking out, or like the market, is because the market prices those movements in already. And I had a chart over here a second ago. The S&P had been taking it on the chin lately, and the S&P is taking it on the chin because these numbers come out. Okay, inflation is persistent. Okay, there's still lots of openings for workers. Yeah, we maybe have this railroad strike. Although, I mean, I think earlier I saw that the S&P futures last night, as it was looking like the railroad strike was going to be averted, started ticking up. And so, that's being very, very volatile right now. But it has taken it on the chin with sort of a drum of bad news, if you will. So inflation is high, but we're not seeing as high inflation in terms of housing and in terms of real estate. There's inventories are going up, and for all of the real estate agents that I've talked to have said that it's still a seller's market, but the market has changed. The tide has turned a little bit. People might be having a little bit remorse about not putting their house on the market earlier. Other people might be having a little bit remorse about buying a house, maybe a $500,000 house that was actually selling for $700,000. So a little bit of buyer's remorse, if you will, but not a ton. The market is definitely settling there. It's not going to be as crazy in the spring, I anticipate. So Fed's going to increase interest rates. They're going to continue to increase interest rates through the rest of the year. All right. You say, like, what's the long and short of this? Because I want to get to some questions here. Let me just go to the end and tell you what I think the score is. Unemployment is still really low, but labor force participation is still really low. Lots of openings. Inflation is high, but stabilizing. Fed is hawkish. They're not backing down. Real estate prices are stabilizing. GDP has fallen for 2 consecutive quarters, but that's not the definition of recession. Everybody thinks that it is. It is not. And so, we could be in a recession. We could be heading towards a recession. Okay. I think that some people are like Deutsche Bank right now has come out and said, we absolutely are not going to have a soft landing. No way. Right. We're going to go into recession, or we're actually currently in a recession. I haven't changed my opinion as this. This is very economist-y to say, on the one hand, on the other hand, and this is what we could be, and this is where we could be, and what have you. So I had been saying for a year, like, wait, you know what? It's very likely that we're in a recession, and it's very likely we've been in a recession since the beginning of the year. And it's also very likely that by January, we're going to hear from the Business Cycle Dating Committee, which is the group that calls balls and strikes on the economy, if you will. Will say, oh yeah, we entered into recession back in January, right? And people were like, I knew it. So I'm fairly certain that that's what's going on, that we're actually in a growth recession. So we're in a recession right now. Things are not great, but things are not awful. And so sounds like a growth recession to me. This idea that we could be ending in a recession soon, since I think we're kind of already there, I don't think that that's going to happen. I think we're in a recession, but if we're not, then we're slipping into a recession. We're in a recession. We're going to be in a recession next week, next Tuesday. We're going to be in a recession next month. I mean, I don't mean to be too cavalier about it, because recessions aren't great. But the difference between these scenarios is actually very little, as long as people continue to do what they're doing, right? And that's why maybe I appear to be a little cavalier about it, because I say, okay, if we're in a recession, what's going on? Well, we have high inflation, right? We have this labor market that's very strange. It's very discombobulated, if you will, all right? And we have these individual issues like this, potential strike here, or this chip shortage for automobiles that's still persisting. And none of that's going to change if somebody comes out tomorrow and says, yep, we're officially in a recession. All those things would be exactly the same as they are today, where nobody has come out and said we're officially in a recession. So the more that people kind of drum on about we're going into a recession and this is going to happen, going to happen, going to happen. Now you could actually get consumers to change their behavior, which would then exacerbate any kind of recession that we already are in. And so the more we sort of drum on about how we're going into a recession, the more likely we are to actually go into that recession because we're going to change people's behavior. And that's my perspective. And you say, okay, so then how do you avoid that? You just tell people, look, just keep spending. We're going to keep doing these policies. Just keep moving forward. Let's try to, let's go get vaccinated. Let's keep yourselves safe. Take care of your family, take care of your house, take care of, your business. And we're going to move the economy forward. We're going to try to keep prices low. And then let's see where we are in January. And then I think that by January, you're going to start seeing prices go down. Housing prices are going to be stabilized. Gas prices are going to be settled below $4. And, by next summer, people are going to say, oh, it's actually things are okay. And then by then, we'll probably be out of the recession that we're currently in. I know that probably doesn't make a lot of people happy, but I think that that's where we are. I don't know. I'm happy to take a bunch of questions now.
Okay, Tom. So Amy asks, so what is the way to officially declare that we are in a recession? Is it Tom Smith declares we're in a recession?
So no, so there's a group from the National Bureau of Economic Research, NBER, that's called the Business Cycle Dating Committee. It's made up of just a bunch of really smart economists. And their job is just to periodically evaluate the economy, and then they identify periods of peaks and troughs. And a peak in the business cycle is where we have gone from an expansion into a contraction. And the trough of the business cycle is where we've gone from a contraction back into an expansion. And so I anticipate that in January or February, maybe as far as March of next year, the Business Cycle Dating Committee is going to release a press release that says, we believe that the economy hit a peak in its business cycle in January of 2022, which signaled the end of an expansion and the beginning of a recession. And then probably in July of 2024, they will release a statement that says, oh, we believe that the economy hit the trough of the contraction in December or January, right? 2022. So that's the Business Cycle Dating Committee. What a growth recession is where you have recessionary elements, but you also have GDP and or unemployment still holding steady. So our GDP is falling a little bit, but unemployment is still going down. So you say, okay, I thought a recession was GDP tanks, unemployment rates jump up really high. Well, it's possible that you could actually be in a recessionary trend and unemployment rate doesn't spike because your economy isn't really shrinking. It's just growing, but it's growing at a very abysmal rate, just barely kind of trudging along. So a growth recession is where the economy is still growing, but so many other parts of the economy are so sluggish that you can't help but say the economy is in a recession, which is different than 2008. So 2008, GDP fell, unemployment went way up, capacity utilization went way down, confidence went way down, and then parts of the economy were, exploding, falling apart. We're not seeing that right now. So I argue that we're in a growth recession. That is, unemployment rate is still going down or stable. GDP is if it's going down, it's going down very little, but it's probably stable, and we're probably going to have GDP growth in Q3 and Q4, but we're still in a recession.
Got it. Deepash asks, if inflation is stabilizing, that just means these high prices are the new norm, correct?
Yes. So the inflation is a year-over-year changes in the overall price level, right? And so if inflation stabilizes, then you say, okay, so what am I paying for? What am I paying for bread? Right, $3.26. So then if you have no inflation from here to next year, then next year the price of bread is still going to be $3.25. It's very unlikely that the price of bread is going to fall back to $2.50 or something. It's not impossible, because prices fluctuate all the time, right? So what you pay for bread this week is actually probably not even going to be what you pay for bread next week, and or what you pay for bread on Tuesday might be different than what you pay for bread on Thursday. But we see that in our regular lives all the time. That is, if you order pizza on Tuesday night, you might get like 2-for-1 pizza, where if you order it on Saturday night, there's no deals. So prices are constantly fluctuating. What prices are high and what prices are going to be high going forward? Yeah, the price of food, right? It's not going to decrease, not anytime that I can see, and there's no reason why you'd have distributors and farmers and whatever else like decrease the price of their food. Like, that's just not going to happen. Gas prices are, they are very, very volatile anyway, month to month, season to season, what have you. Housing prices, again, also very, 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 very volatile. So for high prices, so yeah, for some things like foodstuffs, yeah, the price that we're seeing right now is going to be the price that you're not going to see it go lower consistently in the years ahead. But how expensive is a 2,000 square foot, 3-bedroom, 2.5-bath house going to be a year from now? Probably at or near the price that you're paying now, but 3 years from now, we could go into a housing slump, and so those things can be really, really volatile.
Got it. Scott asks, can you discuss the relationship between long-term interest rates and future inflation expectations? It has been said to me that the 30-year T-bond minus 1% implies the longer-term inflation rate. Is this accurate, and what are the implications?
So people are pricing in. So in order to understand that relationship, you have to understand that the yield on shorter term maturities are going to reflect immediate inflation rates, if you will, because people still need to get positive yields from their bonds. So let's suppose a bond has a 1 year annual yield of, let's say, 3%. Then your nominal yield, then your real yield might be 0 because we were having 3% inflation, right? Or you might be negative, right? Because we're having 5% inflation. So you say, okay, so then if I'm pricing out, like, my demand for bonds is such that I need to get, let's say, a 5 or 6% yield over 20 years, and then I anticipate we're going to have 3% inflation, then the bond's nominal yield has to compensate me for the fact that we're going to have this 3% long run inflation. And so the higher my inflation expectations are, and the fact that I'm going to be dealing without money for the next, I'm going to give somebody my money, government or somebody else, my money for 30 years. That means that I need to be compensated for that. Right. So then the higher long-term yield would reflect that people are anticipating higher long-term inflation because they need to be compensated at some risk-free rate. Okay. And the inverse of this, which is we'll see the bond yields invert. So we've got this thing called a yield curve. The yield curve is like a parabola, should be parabola, that shows you the interest rates, the yields on bonds relative to their maturity dates. So a 3-month, 6-month, 12-month, 10-year, 20-year, 30-year bond will have higher yields because you have to go without your money for a longer period of time. And when we see those yields invert, called an inversion, then what happens is that the longer term rate falls lower than the short term rate. Why? If people feel that the economy is going into a slump or we have really, really high inflation, then the short term yields will jump up or the long-term yields will fall, in which case now your yield curve is inverted in some way. You're like, oh my gosh, longer term rates are paying lower yields than short term. What that means is people are fearful of losing their money, or they're fearful of not losing their money, fearful of having somebody else hold their liquidity for them, because if the economy goes into a recession tomorrow or next week or next year, they're not going to have access to that liquidity. So then the short-term liquidity is top of mind. So people say, okay, you need to compensate me more for short-term liquidity than you do for long-term liquidity. Long-term, the economy will take care of itself, but short-term, I have to take care of myself. And so that's really what's going on, is that the short-term rates are reflecting what people are anticipating today, and then the long-term rates are anticipating a reflection of, let's say, your long-run economic trends.
Got it. Thank you.
Mm-hmm.
Nick asked, how much is money supply with measurement as a leading indicator of a recession?
So the Fed is decreasing the money supply, and they're doing it to avoid a recession. And so the metrics are very interwoven, if you will, because what we have is you say, like, okay, we're decreasing money supply, so this is a leading indicator we're going into a recession. No, the Fed is doing this to avoid a recession, right? They're doing this to push back on inflationary trends. So there's a lot of these indicators which are, let's say, coincidental indicators, right? So your coincidental indicators are things like unemployment rates going up, right? You're like, okay, so that tells me that we're in a recession right now. Okay. But some of these indicators that are tied strongly to the policy, and the policy is being enacted to try to avoid the future recessions, are, let's say, they are weaker indicators, because the policy is being taken on because there's inflationary expectations and recessionary expectations. But the Fed is trying to combat that by engaging in these contractionary policies. So right now, if we're seeing like a decrease in the money supply, then you'd say, so this means we're absolutely going into a recession. No, it means that the Fed is trying to prevent us from going into recession. But they have a good reason to believe that we are or could be going into a recession. So I guess in that regard, it really comes down to, okay, so the Fed movements are what's the real signal, because the Fed is going off of a playbook. They've got, they employ more economists than just about any organization in the entire country. And they have an entire beige book that they use to evaluate the economy. And so they've got hundreds of metrics, thousands of metrics that they're paying attention to. And then their policy, which would then show the decrease in money supply, would be reflective of all of those other data points that they're collecting. It might be a good way to identify that the Fed thinks that something is up, but I don't use it as an indicator. I use the Fed's movements along with these other metrics as indicators.
Got it. Okay. We do have some other questions here.
Sure.
Sherry, and I would put myself in this camp. Very concerned about my retirement accounts, 401k and IRA.
Yeah.
I only have a few years before I retire. Any thoughts on what I should be doing?
Yeah. Don't retire. Yeah, I mean, I'm being a little bit glib about it, right? I mean, I had this right
That's
here,
quite true.
taking the S&P is taking it on the chin. Everybody's unless you have assets that are, let's say, like 3x inverse types of assets. When the market goes into into a bear market, then you've got assets that are working in the opposite direction. So unless your portfolio is full of these 3x inverse types of assets, then chances are excellent that your portfolio is taking it on the chin, as the S&P is taking it on the chin. I was just looking at this because I had a lot of people who were asking me questions about, oh my God, like the S&P is real. I mean, we're falling again, we're falling again, we're falling again. So historically, the market has returned, somewhere around 9% annually returns. It's if you diversify, then you are protected from individual stock movements and individual stock volatility. And it's still the best way, that is, investing in the equities market is still the best way to accumulate long-term wealth. So we all should be taking a portion of our income every single month and putting it into some type of a fund, right? So an exchange traded fund or some other kind of a mutual fund, where we are diversifying across the market to take advantage of any individual micro market changes. And you should stay the course. And so there are probably lots of pithy sayings about, okay, when things get bad, that's when people get rich, right? So when the market is tanking, then a lot of people are inclined, okay, I got to get my money out of the market. Okay. I'm not a financial advisor, but I have a 403B. I have a retirement account. I would like to retire someday. Okay. Getting a little gray in the beard, if you will, and not anytime soon, but someday. And so I'm just like, fine, I'm going to keep investing, keep investing, keep investing. Why? I look at stocks, I look at markets as this. It's these companies are going to be around 10 years from now. They're going to be around 20 years from now and 30 years from now. Ford's not going anywhere, right? Ford isn't going anywhere. Verizon's not going anywhere, right? These GE's not going anywhere. Honeywell's not going anywhere. Coca-Cola is going to be around. Delta is going to be around. These companies aren't self-destructing, okay? So you say like, oh my gosh, like I buy these companies and they've been kind of falling apart lately. Great. Well, then go buy some more of them, because the market is historically going to rebound and you're going to see annual 9% returns. I mean, there is volatility, but year over year, over long periods of time, you're going to see these returns. Now, what's terrible is you think, okay, I was going to retire next year. I was going to retire the year after that. The timing couldn't be worse, because I'm going down here, and it would take a very, very dramatic movement to move me back up. And that is true. I have heard plenty of analysts and economists say that during the pandemic, we as a group lost our sense about value. So we were buying stocks, and the stock price, the value of these companies, wasn't consistent with the revenue that the companies had, the long-term projections on revenues that the companies had. And so the returns that we saw during the pandemic were like way too high relative to what the actual performance of those companies were. And I believe that for some of the stocks that I bought and sold during the pandemic, there's just no rhyme or reason, right? Your GameStops and your Bath and Body Works or Bed Bath and Beyond or whatever they are, right? It's, all those things, these meme stocks, like, you buy them for $3 and sell them for $3,000. It has nothing to do with the actual performance of the company. Okay. So you say like, okay, but now I'm taking on the chin. My portfolio went up, 20% during the pandemic, and now it's down 10%. Well then, okay, but prior to the pandemic, you just have to plot a straight line and say, okay, well, this is where it's going to be 5 or 6 years from now. Because I'm not a financial advisor and I'm not inclined to want to give anybody individual financial advice, my best advice is stay the course. Do not freak out. You're welcome to freak out, but don't pull your money from the market, not while it's down. Just keep buying, but keep buying companies that you know are going to be around for a long time, and know that what the returns you were seeing from a year ago or 2 years ago were aberrations. Like they were made up, like because people were just overvaluing companies. I know that's not any consolidation and consolation. And I mean, it's no fun to have your portfolio tank, but I'm encouraging people, keep investing. Like in the long run, you'll get your money, but you got to keep investing.
Yeah. And don't look at your portfolio. That's my trick.
No, it's no, because people are inclined to, when they look at it, to say, oh my God, like I got to get my money out of there before I lose more. No. Like that's the worst thing you can do is pull your money during a bear market, right? I mean, if you're pulling your money during a bear market, then you don't have any, then you got to get it in before it swings back up. And I am guaranteeing right now, the market is going to swing back up. We're not going to, every company is not going to lose all of its valuation. That is 100% guarantee. So you say like, so now would be a good time if I haven't really started investing. So would now be a good time to start investing? Absolutely, right? Absolutely. This is the time you want to be investing right now.
So I've got a number of other questions, Tom. Deepash asks, how do we break out of the potential cycle of wage increases to pay for higher prices of services and goods? Companies are just increasing the prices of their services and goods to offset the higher wages they pay their employees. So how do we break out of that cycle?
Yeah, I mean, it's what's called it's a spiral or a so it's like this wage inflation spiral that we talk about in macroeconomics. So you increase your prices are going up, you increase your wages or your workers who because you see your profits going up, and then they're pushing more money into the economy, which then has upward pressure on prices, which then creates this additional spiral. So here's how you break out. Let's suppose that you're on the spending side, consumer spending side, right? So what you do, you break out is you say like, okay, so I'm going to get my higher wages, and I'm going to now reevaluate my spending. So I'm not going to spend as much. And we just saw that the trend here is for people to have higher spending than their income. All right. So reverse it, go through your budget and reverse it and just say, I'm not going to let this spiral take advantage of me. So if I get an increase in wages, I am going to reevaluate how many different streaming services I have and cut some stuff out. So I'm going to purposely drop my spending below my income, which if everybody were to do that would have some sort of downward pressure on the prices of all of these things. The other thing is that companies cannot and will not historically just give everybody wage rate increases that match inflation forever. It is not going to happen. So because companies are trying to look long-term and strategically, what they're going to do is they are going to themselves not allow this spiral to continue. So, you say like, oh, well, my company gave me a 4% raise this year. Well, they're not going to say, oh, inflation was 8%. So here's an 8% raise next year. And then they're like, oh, inflation was 6%. So here's another 6%. That is not going to happen for every company forever. They just don't do those things. They just can't afford to do them. So what they're going to do is that you break out of the cycle by having companies being more stingy, but then also having consumers be more stingy with respect to their spending. But you can't have, let's say, a top-down policy where, let's say where the White House says, okay, no more raises for the rest of the year. I mean, that doesn't work. Even trying to cap prices like that, that's President Ford did this in the 70s. He had win buttons, whip inflation now, right? And the policies coming out of Nixon and Ford were, let's put price caps in place. Price caps don't prevent upward pressure in prices. So as soon as you alleviate these price caps, boom, you have these prices that just like shoot through the roof. So the way to break out of this spiral is just companies are going to say enough. Like I'm not going to give you any more wages, and knowing that that's going to happen, then you have to be proactive and say, okay, I'm going to reevaluate my overall spending. My
Got
dog
it.
is chiming in. He's like, oh,
Yes,
I love
yes.
these. I love this discussion. Wage price inflation. He loves it.
So another question, what's the impact of the student debt forgiveness program initiative that has just been announced? Is there any, what's that going to have impact?
I mean, I think it's going to be a very small impact, if anything, right? I mean, so I was talking to my daughter, and she said, oh, this is nice, but I mean, she still has whatever $120,000 worth of debt for her undergraduate and her MBA. Okay. And so, and we're whittling away at it little at a time. And she's like, okay, so this isn't going to be a big impact. I said, no, it's not going to be a big impact. You're not going to get a $10,000 check in your lap. What you're going to get is you're going to get a decrease in either your monthly student loan payments, or they'll just be like a one-time change, and then like now this would be your new set amount. And I said, if you evaluate that and use that thoughtfully, then you might be able to negotiate your own standard of living and figure, okay, this is how much I have to pay for this. Can I put more into investments or more savings? So I think that the impacts are going to be very small, very marginal for individual families. For the government, I mean, it sounds like a lot of money, but these are rounding errors relative to, our total GDP, right? I mean, these numbers are not, they sound like they're astronomically huge. They're not astronomically huge when you think about our $13 trillion GDP, right? And so they're never as large as you think that they are. But for an individual family, it could be enough to get them to reevaluate their spending patterns and get themselves back on track. And that's part of it. And the other part of it is that there was a period of time where there were a lot of for-profit educational institutions that were really taking advantage of students, misinforming them, really taking it, just some really terrible behavior from some of these organizations. And I think a lot of those people suffered, like they didn't get the degree, they didn't get a better job, they still have that debt. Some of that debt has been forgiven, more of that debt is being forgiven. But then there's other people who, were let's say they went into the situation and they just didn't understand the ramifications of this kind of debt. And these kind of adjustments, the United States, through our policies, have made all types of adjustments to all types of things. And this is just one more of those adjustments. I think the impact is going to be marginal, but it could be significant for an individual family.
Thank you. We've got time for one last question. Harris asks, what is a reasonable measure of the inflation rate so that it does not harm the country's economy?
Yeah, the Fed uses a 2% target. So a 2% target would be just a right amount of inflation that things are moving forward, but aren't eating away at your purchasing power. And so 2% is great, but and the Fed has said, in the last 2 years that we haven't had anything close to 2% for years and years and years. We had less than 2% inflation. And so would it be shocking for the economy to, let's say, fall into a scenario where we're having 3.5% inflation over longer periods of time, right? No, it wouldn't be shocking at all. What is really important is that we can get to a level of inflation where we can anticipate that that's what's going to happen over longer periods of time, which allows firms, businesses to forecast, to make better business decisions. Like if we're going to have inflation, but the inflation is going to be 3%, then you can forecast, like you can build a business plan on 3% inflation. So 2% is the gold standard. 2% is the goal of the Fed. If we got down to 3.5% or 4% inflation, it would be a little bit high. but it's manageable, especially if you know we're going to have 4% and that's what it's going to be going forward. So I think we can get there. I don't think we're going to get there by next July. I think by next July, it's still going to be hovering around 5 or 6%. But by this time next year, if I'm being really, really optimistic, yeah, we could be at 3.5% inflation by the end of next year. Maybe that's me being really optimistic, but that's the goal. That'd be a good goal.
Great. Tom, thank you so much for being with us again this morning. It's always fun to have you on for our Business Over Breakfast to kind of decode what's going on in the economy and what it means for us, because there's often confusing and sometimes very conflicting information out there. So thanks for being with us again. And if you could stop your screen share, I'd like to share just a quick note for everybody. We're just so appreciative you're with us today to join us for Tom, and wanted to give you a quick signal on what's coming up next. Stay with us so that we can share the actual schedule, but the first and third Thursday of every month, join us. So these are some of the topics that we've got out there. Faculty are still committing to particular dates. So diving into strategic leadership, examining how you might be able to thrive in a changing, disruptive, uncertain environment. Gosh, we've not been experiencing that, huh? Rethinking your career journey and blockchain decoded. And then, of course, coming up, we also have our short courses. There's still time to register if you're interested. We have been taking a deep dive into executive communications and leadership presence during the month of August. Hope that you'll join us for that if that is of interest for you. Also exploring design thinking for business, as well as disrupting your business strategy. We look forward to seeing you in October. We hope that you'll have a wonderful rest of your day today, and we'll see you next time.